All right, welcome back. We are looking at a somewhat quiet start to the trading day. That misses some of the action that's happening, looking at the TSX basically flat under the hood with investors reacting to the first round of bank results. You've got banks setting aside more money for potentially bad loans, which speaks to some of the economic uncertainty. But our next guest is watching some of the economic data points in Canada and sees inflation trends improving, could open the door for a path towards rate cuts, which is something that everybody in the market has been trying to figure out. Joining us now, Jeffrey Kleintop. He's Chief Global Investment Strategist at Charles Schwab. Jeffrey, nice to have you with us. And, you know, whether it's Canada, the U.S., or other markets around the world, I think everybody's trying to get a sense on when risks are elevated from higher interest rates, at what point the central banks are going to give the all clear to lower rates. When you look at the Canadian economy, what do you see right now?
Well, I think a lot of it comes down to inflation. The Canadian Manufacturing Purchasing Managers Index has a lot of rich data in it, which I use as a crystal ball to tell me where inflation's headed over the next 6 months. It's worked really well historically. And if you look at the output prices component of that index, where they ask business leaders at manufacturing firms, what are you charging? What are you charging your customers? That tends to lead consumer prices by about 6 months. And it suggests inflation maybe below the Bank of Canada's 2% target very soon, perhaps resulting in a more aggressive path for cuts than the market currently anticipates. The market now, of course, thinking June, July might be the time frame for rate cuts, could actually come earlier and be more aggressive than what's currently being priced in. And John, that's important for the banks, of course, because they tend to loan longer term and fund shorter term. So a steeper yield curve could be better news in the second half of this year for the banks.
Okay, so as someone who has to try to position and make calls, it's never easy to make, but any thoughts on when you think the Bank of Canada might cut rates? We already spoke to a guest this morning, for what it's worth, who felt like we should not be surprised if the Bank of Canada were to, come April, say they are ready to cut.
I think April's a live meeting, so to speak. I think there's a 50-50 chance of a rate cut in April above what the market, just looking at my screen here, would say something like, the market's pricing in maybe a 30% chance. I think it's a bit higher than that, given this trajectory in inflation and given what we've seen in terms of the relatively lackluster economic backdrop. Canada is very tied to the global manufacturing supply chain, very resource-dependent economy, and we've seen a lot of weakness there, both in China and around the world. Manufacturing is showing some signs of improvement. I like to watch demand for corrugated fiber board. That's, of course, what we make cardboard boxes out of, and a good signal for global manufacturing demand. That's showing signs of ticking back up again, back into positive territory. So a brighter outlook there, but still one that's more around the flat line and just not declining anymore. All of that points to maybe an earlier entry point for rate cuts by the BOC.
And if we want to just be constructive, we could say that higher interest rates have come and they've rattled certain parts of the economy, but we're still chugging along here. And maybe that's part of the reason why investors have shown a willingness to commit some capital to the equity market. I will note, though, we say it all the time, I've already said it this morning, that when you look at the TSX performance versus the U.S. markets, it's true for 2024, it was true for 2023. You just see that outsized influence for the S&P 500 versus the TSX. When you see that as a strategist, what comes to mind for you?
Well, what you want to look at is it true for the entire market, or is it true just for a handful of stocks? And of course, the U.S.'s S&P 500 is very much driven by those magnificent 7 stocks, making up nearly 30% of its weighting. If you equal weight the S&P 500 index and you equal weight Canada's market, the TSX, what you find is that Canada's stock market is actually keeping pace, even outperforming last year the U.S. stock market. So what I'm finding is broader outperformance among companies with lower price to earnings ratios, particularly lower price to cash flow ratios. You'll find more of those in Canada than the U.S. are actually outperforming. So I think the average Canadian stock is actually doing very well versus the U.S. It's just those high-flying AI stocks in the U.S. which has obscured that in the capitalization weighted benchmarks.
Okay, I know that you look around the world. I spend an awful lot of time asking our guests questions about Canada and certainly the United States. But Japan is an interesting market, and it's a market that actually was once again getting attention over the weekend because Warren Buffett had made some some calculated bets on an underperforming sector, and those have proven to be presumably pretty good. And when you look at the overall performance these days for Japanese stocks, we're starting to talk about some outperformance. What do you make of that?
Yeah, the Japanese stock market has a lot going for it. Just hit a new 34-year high, new all-time high, and there's several reasons for it. One is that Japan is benefiting from this flow of capital back into Japan. The Bank of Japan has signaled, contrary to other central banks, that they may hike rates this year. That is maybe going to push up the yen at some point versus the dollar and other currencies. And so you're starting to see this flow of capital back to Japan, not just cheap borrowing in Japan, funding investments in the rest of the world, but the tide coming back. So you're seeing a lot of money flow back into Japan. At the same time, you're seeing solid earnings growth. You know, big companies like Toyota and Sony get 80% of their sales outside of Japan. So even though Japan's economy was in recession last year, earnings grew 8%, and that's really helped the stocks there. We're seeing valuations in Japan's stock market. Though the stocks are at all-time highs, the PE is only in line with its 20-year average. That's certainly a big discount to, let's say, the US PE for the S&P 500, which is 32% above its average. So I think you've got a number of policy support measures coming into place, along with fundamental earnings growth. Investors are beginning to recognize that.